1. Start with energy, explain with authority, highlight with emphasis, end with warmth. SoFi Technologies Inc. is currently trading at exactly 25.96 USD, seeing a decline of 0.28 USD or 1.09% in today's intraday session. If you are watching the ticker tape right now, you are likely seeing a stock that appears to be taking a breather after a massive run-up, a classic consolidation day that usually bores the day traders to tears. That is the expectation. That is the surface-level narrative that the financial news networks will feed you, that the Fintech rally is cooling off and investors are taking profits. But if you peel back the layers of the 10Q and look at the strategic chess moves Anthony Noto is making behind the scenes, the reality is violently different. We are not watching a stock cool off. We are watching the quiet accumulation phase of a company that has effectively just declared war on the legacy banking system, not by trying to beat them at their own game, but by becoming the very infrastructure they need to survive. The drop to 25.96 USD is not a signal of weakness, it is a mispricing of the most significant pivot in the company's history. The successful weaponization of its AWS of Fintech strategy. Most investors look at SoFi and still see a student loan company that got a bank charter. They see a neobank fighting for deposits against Chase and Wells Fargo. That is the expectation. It is a comfortable, easy-to-understand box to put the stock in. The reality, however, is that SoFi has quietly morphed into a technology conglomerate that just happens to have a bank attached to it. The recent headline regarding the partnership with Southwest Airlines to launch a rewards debit card using the Galileo platform is the smoking gun that proves the thesis. This isn't just a co-branded card. It is a validation that major non-financial corporate giants are choosing SoFi's tech stack over traditional banking partners. When an airline chooses your cyberbank core to run your loyalty financial ecosystem, you aren't a bank anymore. You are a software company with software margins. The market is pricing SoFi at 25.96 USD as a bank, roughly 2x tangible book value, but the smart money is starting to price it as a tech platform, which should command 10x to 15x multiples. This valuation arbitrage is the single most explosive dynamic in the fintech sector today. Let's break down the intraday action. We are seeing some softness today, down 1.09%, largely driven by a rotation out of high beta tech names as yields tick up slightly on the 10-year Treasury. You see this across the board, whether you're checking your Fidelity mobile app or managing your positions on a Schwab Intelligent Portfolios dashboard, the risk-on trade is taking a momentary pause. However, look at the support levels. The stock is holding the 25.50 zone with remarkable resilience. This tells us that there is a bid sitting there, likely institutional, absorbing the retail selling. Why? Because the Q3 earnings report was not just a beat, it was a paradigm shift. Reporting record net revenue of $962 million and, more importantly, a tangible book value guidance jump to $2.5 billion changes the safety profile of the stock entirely. When a fintech company starts building real, tangible book value at this clip, the downside risk of a total collapse evaporates. You aren't buying vaporware at 25.96 USD, you are buying a fortress balance sheet that is growing faster than the actual banks it disrupts. The narrative you need to understand, the one that creates the tension between the skeptical bears and the euphoric bulls, centers on the crypto relaunch. Yes, you heard that right. After stepping back due to regulatory scrutiny, SoFi has officially re-entered the crypto arena for its members as of November 2025. This is massive. The expectation was that banks would be regulated out of crypto. The reality is that SoFi has navigated the regulatory minefield to offer terms Bitcoin and terms Ethereum trading again, just as the digital asset market is heating up. This puts them in direct competition with the terms Robinhood stock trading ecosystem and Coinbase, but with a massive advantage. They are a bank. They offer the security and trust of a federally chartered bank with the speculative allure of crypto. This dual-wielding capability is something no other major player has. It turns the invest online value proposition on its head. You don't need a separate crypto wallet and a separate checking account. You just need SoFi. This integration drives the one metric that matters most: daily active users. When you analyze the term SoFi Invest platform metrics, the cross-buying behavior is the secret sauce. The company reported that 35% of new products were opened by existing members. This is the financial services productivity loop in action. It means their customer acquisition cost is effectively plummeting while their lifetime value is skyrocketing. A customer joins for a high-yield savings account, then gets a credit card, then buys some crypto, then takes out a personal loan. By the time they're 3 products deep, they're sticky. They're not leaving. This moat of stickiness is what the algorithm trading bots miss when they sell the stock on a 0.28 USD drop. They see a lower price. They don't see the compounding unit economics of a user base that is becoming mathematically impossible to churn. Let's talk about the Galileo and Technisys side of the house, because this is where the terms Tesla stock comparison actually holds water. Tesla is valued as an energy and robotics company, not just a car company. SoFi should be valued as a cloud-native banking core, not just a lender. The Technisys acquisition was criticized at the time as too expensive, but now, with the cyberbank core powering the new commercial payment sponsor banking program, we are seeing the fruits of that labor. They are effectively building the operating system for the future of finance. Every time a Fintech, an airline, or a retailer wants to offer financial products, they have 2 choices: build it from scratch, takes years, costs millions, or rent it from SoFi, takes months, costs fees. It is the AWS model applied to money. If they can capture even 10% of the embedded finance market, which is projected to be a $1 trillion industry, the stock price at $25 is a rounding error. We have to discuss the financials because the numbers are the truth serum. The 38% year-over-year revenue to $962 million is staggering for a company of this size. But the real story is the GAAP net income of $139 million. Critics said SoFi would never be profitable. They said the stock-based compensation would eat all the margins. They were wrong. The scalability of the digital model is finally outpacing the fixed costs. This is the operating leverage inflection point. For every incremental dollar of revenue, a larger percentage is falling to the bottom line. This is the exact moment in a growth stock's life cycle where the PE ratio starts to compress rapidly, making the stock look cheap, even as the price rises. For those of you engaging in self-investing or using investing sites like Morningstar to track this, pay attention to the earnings surprises. SoFi has beaten estimates for consecutive quarters. This serial outperformance forces analysts to constantly revise their models upward, creating a tailwind of upgrades. However, we must address the risks. You cannot have an honest conversation about SoFi without talking about the macro environment. The personal loan business is sensitive to credit cycles. If the economy enters a hard recession and unemployment spikes, defaults on personal loans will rise. SoFi has moved up market, targeting high-income earners, average FICO scores of 750 and salaries of 160K plus, which provides a buffer, but they are not immune. The Terms Fidelity Wealth Management crowd is cautious here for a reason. They remember 2008. They remember what happens to unsecured lending when the music stops. This fear is what keeps the short interest elevated. But here's the contrarian take. SoFi's agility allows them to tighten credit standards faster than a traditional bank. They have better data. They see your cash flow, your spending, your investments. They can predict